Hello and a very warm welcome to Econoday Unplugged on Thursday, the 4th of May 2023. Terry Sheehan's on the US East Coast, Max Sato is in British Columbia, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. Well, taken together with the latest raft of central bank announcements, the recent deluge of real economy and inflation updates has given investors plenty to chew on. With a few notable exceptions, monetary authorities have been tightening policy aggressively for some time now, but just over the last couple of weeks or so, we've seen further increases in key interest rates in the US, the Eurozone, and Australia. And indeed, the Bank of England is widely expected to follow suit next week. All of which raises the question then, is policy actually working? So in today's podcast, we'll have a go at finding out. So Terry, let's come to you first then. I guess what was widely expected, FOMC yesterday voted to raise rates for the 10th consecutive meeting. And that not
Yeah.
long after we heard that first quarter GDP growth had slowed to just over a 1% annualized rate. Core PCE inflation in April equaled its lowest level since October 2021. And we've now got the funds rate target above 5% for the first time since 2007. So is policy working or not? And if there's a yes to that, might this be it for the current tightening cycle?
Well, I think it is yes, and I think it is also an end to the current tightening cycle, although Chair Powell clearly signaled that the FOMC is willing to lift rates further if they think they need to. But we are seeing the kind of numbers that seem to be consistent with Fed forecasts of slower growth in the first quarter. We've still got what Powell calls a very tight labor market. So we're not seeing high levels of unemployment, but we are seeing reductions in several different measures of inflation. And altogether, it suggests that things are moving in the direction that the Fed has wanted them to go. So at the moment, I won't say the US economy is looking great because it isn't, but it looks like 500 basis points worth of rate hikes have caused policy to be restrictive enough to have an impact on inflation, but it hasn't entirely derailed economic growth yet. So things pretty good for the Fed at the moment.
Okay, a couple of things I suppose I'll ask you on that. I think Mr. Powell sort of noted that looking at some softening in the sort of more interest rate sensitive sectors of the economy, such as housing and business investment, which I guess is fine, although clearly reduced investment can actually reduce output, which at the end of the day may not be what they want to see. But is he seeing the kind of indications that perhaps you need in more, the likes of consumer demand, which could actually help to reduce price pressures?
Well, consumer spending was actually stronger than expected in the first quarter. And we're seeing the first reports for April, which are also suggesting things like motor vehicle purchases were way up in April. So we are seeing consumer spending, at least tentatively, looking pretty strong at the beginning of the second quarter.
And what did he say about the labour market? I mean, clearly, actually on every podcast, you'll chip in about the latest developments with the US employment market. And by and large, it's been a case of pretty well uniformly strong numbers for an awful lot of months now. So we got the next set of employment data obviously coming out on Friday. Tomorrow as we record this. What's expected there? And do you think that given that perhaps the market's now thinking, such as you're talking about, that interest rates have possibly peaked anyway? Don't know yet, clearly, but might have peaked anyway. Were we to get another strong set of figures coming out tomorrow, that it could sort of really, really rock the boat a bit?
It could. Right now the Econoday consensus is for up 178,000 on non-farm payrolls. Just, that's close enough to the 200,000 mark that seems to be sort of the point at which, we would say that job growth is kind of normalizing. This is what Powell called a very tight labor market. We're still looking at a very low rate of unemployment in historical terms. Some sectors are struggling more than others. Manufacturing payrolls seem to be weakening. We've had a lot of layoffs in technology. Retail sector is seeing some closures of a few major chains, like over here it's Bed Bath and Beyond. But hiring in areas like leisure and hospitality are clearly ramping up for the summer months. So it's actually a pretty good labor market right now. And the other thing is that we've now got evidence that small businesses are finally beginning to find the workers they need for their unfilled jobs. So it means to some extent that the reductions in wage pressures have now made them able to compete more for the available workers, some of whom have been laid off in the last couple of months.
Okay, interesting. Right, let me just come at this quickly from a slightly different angle. Money supply growth. Now, I guess not too many central banks pay a great deal of attention to that these days, but I mean, your M2 figure is what, running about a -4% year on year annual rate now. Is that a concern? Because if I remember rightly, it's kind of the weakest numbers we've seen, well, apart perhaps from some of the the COVID distortions, since the Great Depression. So is the Fed making any reference to the fact that money supply is, well, pretty well falling out of bed at the moment?
They are not talking about it at all.
Why do you think that might be?
Well, I think partly because they're not targeting the money supply right now. And, uh, they're still dealing with a lot of disruptions, the after effects of the pandemic. So
Mhm.
I think it's just, they don't see it as the best way to um, convey what they want to do with monetary policy.
Okay, fair enough. Unless it's hard to find a central bank which puts too much faith in money supply at the moment. One last question I would like to ask you before we move on. Banking sector. Clearly, we've had a number of wobbles, and Steve, we've still got some going on, US banking sector side and indeed globally as well. Do you think the recent problems we've had there had any kind of impact on the Fed's decision yesterday? And indeed, is it something they're worried about anyway?
Well, I think they are definitely on heightened alert as far as the health of the banking sector goes. I think they are trying to get ahead of any other banks uh, failing due to a lack of supervision and proper regulation. Uh, but they have set up a special lending facility um, to help smooth out some of the problems in the banking sector. We are seeing more borrowing from the discount window, the primary
Hmm.
credit rate. So they are ensuring that there is credit available to these banks so that they can get their problems under control. And there were a lot of questions yesterday to Powell about the health of the banking sector,
Right.
and he, stuck to the party line that it's a solid and resilient banking system with relatively minor problems right now that are being addressed. So, um, but he also was very clear that it's caused tighter credit conditions, and this is going to weigh on the economy. So I do think it was part of their decision, not so much in terms of whether they were going to do 25 basis points or not, but in terms of being ready to uh, at least slow down on looking for future rate hikes. And although the statement itself was hawkish and Powell was clear that they are willing to continue to raise rates, uh, it really is that looking like they're ready to pause right now because they have tighter credit conditions, partly because of the situation with the banking sector, and they have the classic long and variable lags
Hmm.
yet to show up from past rate hikes. So I think they're just, it's time to at least pause And I think we may well have seen the top of the current rate cycle.
Okay, watch your space, they say. Anything else you'd like to put into the old pot before we move on?
No, thank you.
Okay, brilliant. Many thanks for that, Terry. Right, Max, let's move across to you then. I guess when you look around the central banking community, the Bank of Canada can say perhaps more than many that policy is working relatively well. Well, there's no change in interest rates since January. Inflation's coming down. The economy is still expanding. So do you think they're actually sort of maneuvering themselves to achieve the proverbial soft landing?
I think so, but if you listen to the governor's speech in Q&A and press conference today, there is a slight concern about the possible over-tightening, not from their own interest rate hikes, series of hikes last year, but from kind of automatic tightening from the financial industry stress. He's saying, Governor Macklem saying that the spillover effects from the US and Europe to the Canadian banking system, the impact is muted, but he still thinks the banking sector has to adjust to higher interest rates. And if the global financial stress becomes worse, then they might see an unwanted over-tightening. But at this point in time, he's saying the interest rates are high enough to slow the economy. I think the stickiest point is the stickiness of the service prices, both the US and Canada. So I think they're a little bit concerned, but comfortably in pausing mode on condition that inflation is going to come down from 8 to 4, but it has to come down to 3 and then finally to 2. And the governor has been saying the path from 3 to 2 is going to be more difficult.
Yeah, and I'm sure that's true for a lot of central banks as well. But presumably, given what you've been saying, the idea of any kind of interest rate cut out the Bank of the Canada at this stage is an absolute non-starter.
Yeah, their point has been really clear. Today, too, the governor said that it is too early to be even talking about it. And I'm just looking for the direct quote. But right now, he said, we've been very clear that we're pausing to assess whether interest rates are high enough to get us back to the 2% target. And that doesn't sound like a conversation about cutting, does it? So I think in the financial market community, the majority is, I think, is still looking at pausing until the end of the year.
Okay, fair enough. So far, so good for Canada then. Let's move across to Japan, where, of course, interest rates remain as low as ever. But we've got core inflation accelerating now. I think we've had 10 straight gains. April, if I remember rightly, was the highest since December 1981. Inflation expectations seem to be climbing too. So do you think keeping interest rates as low and for as long as the Bank of Japan has could actually be stoking up some inflation problems further out?
I don't see a huge risk there. In North America, the central banks want bad news for their own policy conduct. But in Japan, good news is still good news. You know, more jobs, tight labor market, and then resilient to consumer spending, and the potential demand for business investment in equipment is still high. So the point here is, I think, you know, if you're coming from the US or Canada or the rest of the world in major economies, if your central bank raises interest rates, then it's going to be harder to borrow money, or your debt repayment will go up. But in Japan, the interest rates have been so low, and it's not like if you cut interest rates and keep it low, people are going to start borrowing money and buying homes and buying new cars. It's not like that. The consumers have been very careful because the real wages are still falling, And business have been, they've learned during the downtime that the easiest way to show profits for the shareholders is to cut costs and keep the costs down. So I don't think they have really come out of that cycle yet or mindset. But then, because of this huge spike in food prices, fresh and processed and durable goods, companies are actually either giving one-off benefits to workers to keep them with them, or actually raising the base wages. So the point is, it maybe this fiscal year may be better, much better in terms of wages for workers, but is it going to be sustainable? That's what the central bank people are looking at.
All right, fair enough. Let me also ask you about because we've been so used to Japanese interest rates being so low for so long now. I wonder, do you think there's a danger that the mindset has become now that, well, Japanese interest rates never move. Effectively, you've got a negative interest rate which could well be seemingly around forever. Do you think there's a risk that if we look across to somewhere like Switzerland, we had the Swiss National Bank, which was pegging its currency against the euro, effectively put a floor under it for the best part of 3 years, and it basically people were buying the Swiss franc and they had to simply give up on it, and the Swiss franc actually took off and appreciated over 20, almost 30% in the space of a couple of weeks or so. Do you think there's a building risk now that as and when presumably at some point we'll get to the stage where the BOJ simply says, okay, we have had enough of the current yield curve control levels, we're going to have to start tightening policy? It could lead to a really big move into the yen that the BOJ, Ministry of Finance, whoever it might want to be, simply wouldn't want to see.
Are you talking about possible reversal of the dollar yen, and we're going to see a high yen again, or?
Yeah, exactly that. A big move into the yen out of dollars, presumably euros, perhaps, and every other currency as well.
Yeah, that's always the risk, because no central bank or government can control the exchange rates once people think it's time to buy. So that's always a risk. But at this point, if you take a look at the dollar yen rate, it is still relatively weak. Although if you take a look at the outlook for the rest of the year, it's not going to be as weak as last year. So that's probably good on the inflation front. Import costs are not going to be so high compared to yearly levels. But when it comes to policy making, I think my guess is they're going to be doing kind of a stealth tightening, expanding the long-term yield band range slightly wider, and also maybe they will stop the negative interest rate on the short-term rate, and that will actually, it could actually flatten the yield curve. But the only problem with the yield curve formation is 10 years okay, but mid-range is a little bit too high. So at some point they have to give up on the yield curve control, which is kind of a legacy from Kuroda's days. But if you do that right now, as you said, they could risk a huge reversal, and that's not what they want to see.
Okay, I guess from what you're saying, they've actually you would appear to think that the BOJ finance minister have actually handled things pretty well as far as Japan's concerned. So if you were to give them a mark out of 10 for how effective policy has been so far, what would you give them?
I would say middle of the road, 5.
All right, I'll spend.
Let me just add something.
Yeah, please do.
What really concerned Japan, especially Ministry of Finance people, was they didn't have enough cash to intervene to protect the yen. And they did intervene in the past to sell the US dollar and buy yen. But that was effective because the Fed, the Treasury joined too. But so when it comes to defending the yen, not defending, stopping the yen from going too high, they have lot of cash. Basically, they can print yen as much as they want. So that's the defending side when it comes to currency control may not be so bad.
Yeah, fair point. Very fair point. Okay, great. Thank you very much for that, Max. Right, let's move across then to Mr. Jackson. Brian, I guess much like
Yes.
its Japanese neighbour, inflation in China has not been a problem for the PBOC, whereas the economic slowdown has. First quarter GDP, I think, correct if I can say, we beat expectations, but there still seems to be quite a few doubts about the economic outlook for 2023. So what are your thoughts on how policy is managing the post-COVID economic recovery, and where do you think it goes from here?
Yeah, I mean, it's quite out of sync with most of the rest of the region, let alone other parts of the world, in terms of where they are at with policy. As we know, they weren't really providing fiscal and monetary stimulus throughout 2022. They were going the opposite way, not using monetary or fiscal policy, but using public health policy really to clamp down on the economy with the tight restrictions that we saw, right up until the end of last year. Mm-hmm. So a very different set of circumstances, and so where we are now is quite a different place to be compared with most other parts of the region. So I think what we saw was, obviously at the end of last year, they relaxed all those COVID restrictions that they had in place, and we got a bit of a sugar hit in the first couple of months. There was some pent up demand. There was a bit of a sort of mini recovery in the first couple of months. That was complicated by Chinese New Year, but we definitely saw some improvement. But now it seems to have settled back down again. If you look at the PMI numbers, if you look at those official numbers that we had a couple of weeks ago, it seems to still be sort of quite subdued for the time being. Not disastrously so. I don't think they're it's panic stations yet, but we're not seeing a really strong sustained recovery in some of those indicators.
Higher interest rates in China, then, I guess, is still very much a non-starter for now.
Yeah, that's not really on the agenda. I mean, just a few weeks ago, we had a little tweaking with reserve requirements for banks. So, if anything, that's still the bias at the moment. I don't think they're looking for drastic changes in either direction, but they're not having the same pressure as other countries in the region in terms of dealing with inflation. Even the PMI numbers that we had this week have sort of shown a bit of a moderation in some of the price pressures. So it's I think a reasonably steady course for the time being, but if anything, trying to get those activity numbers up.
Fair enough. Right, let's move to your immediate part of the world then. So I guess one of the RBA is one of the most interesting central banks at the moment, in a sense that it clearly picked up a lot of flack for its failure to control inflation. Not that it was alone in that by any means, but and it seems as if the way in which policy is going to be set in the future might well change. But before we get there, just when it seemed that we're getting close to, or perhaps at the peak to interest rates, the RBA this week decided to surprise at least most people in the market with another 25 basis point hike. So what's going on?
Yeah, I just think we're in a sort of uncharted territory at the moment. It's not really, I don't think anything's on autopilot. And obviously, for large parts of time, you know that policy is either on hold for a long time, or they're on a tightening or loosening cycle, and you can sort of predict with a fair bit of confidence, what's happening over the next, at least few months. But we're sort of not in that territory right now. It's quite fluid, the situation, and I don't think we can just assume that we know what's going to happen next month. There's going to be a lot of data dependency, and just a lot of attention, particularly given to what the RBA is doing with its forecast. Later on today, just in a few hours from now, we'll actually have their quarterly update on the outlook. So that'll be interesting to see if there's any change in the trajectory of inflation that they think we're going to see. At the moment, for some time now, they've been saying, okay, inflation is going to start falling, but it's still going to be another 2 years from now before it's at the top of our 2 to 3% inflation target range. So they're not predicting that this problem is going to be fixed anytime soon. So with that forecast in place, yeah, there still could be some more policy moves if they think inflation's not falling quickly enough going forward.
Okay, well, in terms of policy moves, as I mentioned, it looks as if, I understand, proposals have been put forward anyway to make some, if you like, sort of structural adjustments to where the RBA board works. Perhaps see if you just quickly fill us in on that and give us any thoughts about what you think it might mean for the way policy is going to work going forward.
Well, probably the headline, of that report is that they still insist that the RBA's independence is going to be maintained. So that's probably the main thing to bear. And so there's no suggestion that we're going to have a return to the government pulling the strings on interest rates. But there has been concerns and criticisms about how the RBA has conducted monetary policy in the last couple of years. One of the issues that you do find is that a lot of the people on the board, they have some outside members on the board, and they tend to be business people who have a lot of experience in running a big business, and so they sort of get invited onto the board to have that expertise, but they're not necessarily people with a PhD in economics who can sort of run through all the models and predict interest rates and inflation, all that sort of stuff.
Mm-hmm.
So there's this idea that there's not enough economic expertise on the board, and that they sometimes just go along with what the staff tell them to do. Governor Lowe has sort of come in and say, no, that's not how it works, but that's sort of the perception. So what they want to do is change the composition of these external members going forward, and make it more, very much people who have an expertise in economics. Apart from that, the other change is to reduce the number of meetings each year from 11 down to 8, and that's to give people a bit more time to actually think about things between meetings, and to have a little bit more deliberation. That's the stated idea behind that suggestion, and also to split the management a little bit. So at the moment, we've got a board that deals with monetary policy, but also deals with sort of more governance issues relating to the bank. So they want to split those two roles out specifically, and just have a board that's specifically focusing on monetary policy.
Okay, very much like the Bank of England. Can I check though? But the idea is that they will be retaining existing inflation target. Is that right? Yes,
but also going forward to having a specific growth employment objective as well.
When you say specific, is it going to be a vague type thing, or is it going to be kind of like the Fed, whereby you're supposed to basically do whatever you can to try and get the employment numbers to be as strong as they can be without jeopardising your inflation numbers?
Yeah, I think it's not going to be, they're not going to nail down a very specific growth or employment objective, but just having that as an objective of making sure that policy is set to deliver both price stability and strong economic growth.
Okay, interesting stuff. Anything else you'd like to put in from your part of the world?
Well, I think just the main point to note about what you're saying at the start of the podcast is that there's quite a bit of variation in what's going on across the region right now. It's not sort of one size fits all. We don't really see all the central banks in the region in sync. Obviously, as we just mentioned, China, they're not looking to really tighten policy. Australia, they paused for a month and then they resumed. South Korea, they've paused for a couple of months. India, they paused last month, but who knows if they'll continue to keep policy on hold. New Zealand has just been steadily going, hiking throughout this whole period. They haven't sort of shown any indication to pause yet as well. So right across the region, there's quite a bit of variation and volatility in how central bankers are responding to the data. So it's quite interesting, and I think it just really highlights that we need to keep a close look on the incoming data for all these countries.
Very truly said. Excellent. Okay, great. Thanks for that, Brian. Okay, let's quickly whiz across through to Europe then. Well, I guess in Europe, with most people, at least outside of the ECB anyway, would have accepted that the central bank was far too slow to start raising interest rates. And that's one reason why we saw another hike coming through today, albeit only 25 basis points. And that's down from what we've seen in the previous tightenings. That increases means that the tightening since last July, when they began to push interest rates, is up to some 375 basis points, which by ECB standards is one heck of amount of tightening. It also means that the key deposit rate matches the highest number we've seen since May 2001. From what we understand today, it looks as if some of the governing council hawks actually wanted to see another 50 basis point hike, as we saw in the previous 3 meetings. So although some people are taking a view that, well, look, they've cut from 50 basis point increases, 25 basis points, this is the start of, possibly the top end of the interest rate cycle. It's certainly far from guaranteed. And indeed, the fact that they made some slight adjustments to their quantitative tightening program, they'll be ending their partial reinvestment of maturing assets under the asset purchase program as of July time. That kind of seems to me that they might well have had to been forced to put that forward just to keep the more hawkish members of the ECB content, or at least willing to go along with just a 25 basis point increase. So excuse me, nonetheless, it is, say, the smallest increase we've seen out of the ECB for some time, and it will inevitably, following the likes of Fed, have markets believing that the top end interest rates may not be too far away. Which brings us back to the original question, is policy actually working now? Well, I guess in terms, when we look at the inflation numbers, they're still miles above where they should be. The April figures showed a headline rate up at 7.0%. So that's some 5 percentage points above the 2% target. The core rate still running, the narrow core rate at 5.6%. So overall, the big picture on inflation is still far beyond what the central bank would want to see. And indeed, in her press conference after today's policy statement, President Lagarde was still warning that, bottom line, inflation still offers substantial risk, to quote her. So it's certainly far from clear that interest rates here have topped out. In terms of the economy, well, I suppose where we can say that, to the extent that that they're looking to try and dampen down economic growth, where it is showing through, it's coming through in the financial data. Annual growth of private sector lending is now fallen in 3 of the last 4 months. Indeed, growth in March was at the weakest. Annual growth was the weakest since November 2021. The bank's own first quarter lending survey found further sharp declines in both loan demand that going to households and going to non-financial corporations. And indeed, banks are expecting a further tightening of credit and a further fall in loan demand once we get into the current quarter. So all of which should, of course, help to reduce inflation in due course. But from where we stand at the moment, there's clearly some way to go. So I guess the big picture for the ECB at the moment is that they're hoping, I suspect, rather more than expecting at the moment, that we will see some kind of decline coming through in underlying inflation measures. But you look around what's going on, it kind of seems to me that these core rates are going to remain high and certainly sticky anyway for some while to come yet. So near-term risks, at least as far as the ECB is concerned, I think that we'll see interest rates having to go higher. And so, and part and parcel of that is very much the fact that they really were rather late in actually starting the tightening process in the first place. In terms of the UK, of course, we'll get the Bank of England meeting next week. As mentioned in the intro, they're widely expected to come out and increase interest rates again, probably by 25 basis points. Not a done deal yet, but is policy actually working over here? Well, if it is, I guess it's not doing a great job, because we've had, 11 successive increases in bank rates so far, totaling 415 basis points. And yet we've still got inflation as of March up in double digits at 10.1%, and even the core rate, that's up at 6.2%. That's just a couple of ticks short of the 30-year high we saw last October time. Wage growth still too is far too high. We've got a headline rate of only just shy of 6%. But it's interesting, the bank now it's almost let's say it smacks of desperation, but is coming out with various metrics of how to try and look at what's going on with the wages market. And they now seem to be talking more about looking at 3 monthly changes in wages. And certainly if you do look at that, there are some at least tentative signs that the peak to wage growth may have been passed, but that's far from guaranteed. But whatever you can say about wages, the bottom line is that at this stage anyway, the labour market, if indeed it is loosening, is only doing so extremely slowly. So basically, I think for the BOE, there's still more work to do. Where policy has certainly hit the economy, though, a bit like as we're seeing in continental Europe, is in the financial data. M4 is no longer a targeted variable over here, but the bank does still look at it, and particularly the credit components of that. We saw another contraction in the broad money aggregate in March time, and that indeed was its 4th decline in the last 5 months. So annual growth there now is just 0.4%, its weakest since December 2015. And within that, the lending component was again a key factor. So we've seen third decline in many months there coming through in overall M4 lending. Yearly growth stands at just minus 1.1%. So a bit like the States in many ways, the financial variables now very much seem to be responding to the interest rate tightening we've had so far. So do expect another interest rate hike out of the Bank of England, even though we're going to see almost another split vote next week. Also, I should just mention for next week, we will get a whole wodge of UK numbers, which will give us a better feel to what's going on. These will include the provisional estimate of first quarter GDP alongside the likes of industrial production and trade numbers. So they will be important for the bank to give it a better feeling about what's actually happening at the moment. But in general, it's safe to say that for certainly Europe in general, central banks at the moment, their focus remains very much on what's happening, of course, to inflation, but also what's happening to the labour market in general. Okay, then, I guess that's probably enough for us for today. So let's wrap it up there. In some, what can we say? Well, there are clearly signs in some parts of the world that monetary tightening is having its desired effect. And bear in mind, of course, as Brian was saying earlier on, that many central banks see the peak effect of higher interest rates not being felt for the best part of perhaps a year and a half or so, which means that much of the impact of the hikes we've seen to date is still to be realised in the actual data. And it is interesting just looking at what Hugh Pill, he's the Bank of England's chief economist, said last month, that one of the big problems for policymakers is that the economic models currently being used to make the inflation forecast upon which, of course, so many central bank decisions are made, they're estimated on data that didn't include the huge shocks caused by COVID, the war in Ukraine and the like. And as such, of course, are only of limited use. So it's all the harder at the moment for central banks to know what's going on. The numbers are very volatile. And Brian was saying this, it simply means you've got to keep an eye on the data. And with that in mind, of course, since the data are still the most important tools you've got at the moment, it may make economic forecasting even more of a lottery, but do keep up to date with what's going on in the actuals. So all the key market moving statistics and events in Econoday's global economic calendar. And with that, I'm Arthur Terry, Max, Brian, and me. Thanks as always for listening. We hope to see you next time. Bye for now.